Welcome back to another episode of Drilling It Down. This is your host, Wes Lyon. Co-hosting with me today, Liam Fitzgerald. Liam, welcome to the show.
Wes, thanks so much for having me. Very excited for today.
Absolutely. So today's topic, we want to talk about indexed universal life. Is that what IUL stands for?
It is. And yeah, a pretty big word, and we're really going to dive into it. I know it's a type of permanent insurance, but it's definitely a special brand.
It's insurance. Oh man, it's weird. I keep seeing it advertised as an investment product.
There you go. Well, it oftentimes is marketed as such, but we'll learn pretty soon that, anytime a policy, an insurance policy wants to be made like an investment policy, they're usually not good at either one, right?
Yeah, no, definitely. I know we've talked about this quite a few times, but it keeps coming up. So, I want to talk about a little bit more in depth here. And we came up with about 8 quick issues with these policies. This only took us about 10 minutes to come up with, if that tells you how easy it is to kind of pick some of this stuff apart. But we wanted to go through and, kind of get a little more granular on the why behind these things, on why they don't work. Now, quick overview for those of you who don't know what an indexed universal life policy is. It is a type of permanent insurance policy, meaning by permanent, it's not a term, basically a term life insurance policy. You own the life insurance for the term in which you need life insurance, and then after you don't need it, you no longer pay for it. But there's different types of products that are permanent life insurance policies, and they either pay out upon your death, or as we're going to talk about, you can take loans from them, distributions. A lot of people really, I don't think, sell these as life insurance. So we live in a little bit of gray area because, Liam, I believe you had to take did you take the Series 65?
It was actually 66, but it was
66.
Close enough. Pretty deep in the laws
so you had to take
there.
the combo.
Exactly.
So for those of you who don't know what we're talking about, there are securities licenses to sell and those aren't even to sell securities. Those are to give advice. So Liam had to take those. You're also a certified financial planner.
Correct.
I had to take all of those as well. And then you were at Vanguard. I was at Dimensional. Did you have to take the Series 7?
Series 7 to even talk about trading a stock, right? That was what you did to be able to both give advice, but then also trade as well.
Now, that one's a little bit funny because technically working on the personal side, you don't need a 7.
Right.
It's something a little more either on people selling stocks, but you're part of Vanguard, which does both. So you're on the personal side, but that is a little technicality. Now, in order to sell an indexed universal life policy, you have to take an insurance exam, right?
You do have to take an insurance exam. Now, the term exam, and apologies for any of our friendly insurance agents watching, but it's not necessarily as in-depth as some of those other exams we were talking about.
Right, that's weird. I took that, Liam.
Well, I'm sorry to really offend you there, Wes.
I'm not certain I studied for it, but
right.
I did take it and pass it.
Maybe one weekend, right? All it took.
We used to work for a fee-based RIA, and we didn't have a broker. We would directly sell some insurance, disability, term life. We don't do that just because when you're only selling the products that are right for people, the commissions are tiny. I'm not even doing the paperwork for the tiny commission. We send it out to a broker. That broker gets to make all the money. He loves us for that, but he just shops the cheapest policies, and that way there's no conflict on our part. We don't have to deal with the paperwork. It's just time well spent. But as you can see, it's much easier to become licensed to sell an insurance product, and it's not regulated in the same manner that you'd get regulated as far as investment world goes. And that has to do with performance reporting. It also has to do with what you show clients or potential clients, and really anything under the sun, which is, I guess, kind of funny, but not really, because they rip a lot of people off that they can actually market these as a great investment product. I mean, half the marketing sees, save for your family, get tax-free income in retirement. And they can do all of these things in which the government is trying to regulate, but because they do it behind an insurance wrapper, they don't have to actually follow the rules, which leads to, I've seen some people honest about marketing these things, a lot of people dishonest, and I think even sometimes the honest people they just don't understand the investments in the back end, or, have the true deep understanding of what's going on to realize why this might not be the world's greatest idea.
Exactly.
But Liam, I came up with 8 things here. Tell me which one stood out to you. What are you looking at?
A good list right here. I would love, because I know your background, especially being in the investment world, working for Dimensional, you know a lot about the indices. And yes, when we look at some of these accounts, we say, okay, the S&P 500's there, maybe the Russell 1000. I recognize those as indexes. It sounds like they might be back tested. How are these indexes truly implemented into some of these policies?
Yeah, so everyone's going to be quite a bit different. But generally speaking, what we're referring to in these indices is when you put money into this policy, it kind of grows in this investment account, and you get to participate with the market. I think that's the word they love to use. You get to participate in market growth, and they put a 0% floor on it. And what they're really talking about is you have participation in an index based off their rules. So sometimes the indexes are very straightforward. Like you see the S&P 500 index. Everybody knows what the S&P 500 is. Well, maybe not knows. They've heard of the S&P 500. I don't know how many people know exactly how it gets constituted, details, but everybody's heard of it and can generally talk about it. So you can latch on to that one. Sometimes, though, they show policies, and they'll show policies with some sort of index. Sometimes an index creator created it. Other times it didn't. And sometimes you have to dig into the details if it's too good to be true. Like, oh, look, this index universal life policy would have performed at 16.5% annualized over the last 25 years. And this actually happened where somebody showed me this. So I looked at the index, and I went to the index provider's website, which, by the way, for those of you that don't exactly understand what indexes are, probably a whole conversation for another day, but some entity is doing portfolio construction rules in a theoretical space, and they're creating, these are the rules, and this is what gets included, and those are the rules. So the S&P 500 is the largest 500 in the U.S. So that reconstitutes on a certain day in the largest 500 companies in the U.S. by total outstanding share price. So number of shares multiplied by the share price. That is going to be your metric to get into that index. So sometimes you look at these and you look at the methodology and you go, what in the world? Somebody did rocket science to get here. And then you look back, and I'm looking at this illustration showing, hey, look at what this policy would have done over 20 years. Well, the index was created 2 years ago. Somebody went and looked backwards, and they were like, hey, this is fantastic. Look, if I did this much S&P 500, they just over-engineered this thing to be the perfect index for the last 20 years, which clearly ain't going to be the perfect index for the next 20. But yeah, it's just a back-tested index. And when I was working at Dimensional, I had a colleague of mine, and we were always selling against some of this stuff, because some of these indices, they use them in life insurance. But some investment companies, they take this garbage data and they actually put it to work, and they invest this way. And I remember sitting there, and some knucklehead advisor is showing us this great thing, and how he's going to invest in it. And this guy, we're young, we're doing all the math behind it. This guy was older and wise, and he just turned with a smile on his face and looked and goes, I've never seen a back test I didn't like. And to his point, what he was subtly saying is, yeah, they probably came up with 50 iterations of this that didn't work, and they threw out the garbage. And then number 51, that was the one that worked. So, when you're looking at something that hasn't been existed or has been back tested, or, look, if I would have done X, Y, and Z, well, it's like, yeah, if I would have bought Sears when it was $2 a share, sold it at the top, and traded it all in for Apple, I might have more money than, Bill Gates, but I didn't do that.
Exactly.
So, you have to be careful if they just really back tested, created an index just to make their illustration look good.
Makes sense. Yeah, I'm going to jump on your list, because I noticed one point we had was some really bad in-force illustrations. And I think about a mutual client that we have that thought they were secure for retirement. They were getting ready to go off and travel and sell their practice and enjoy. And they really put most of their eggs in this basket of, hey, I have X amount on a guaranteed basis for life, right? And almost an annuity type. Talk to me about some of these illustrations. Seems to me borderline illegal to make it seem like this.
Definitely. And by the way, if you're listening to this, because I remember we jumped on the phone, so like, oh, that was me. And I was like, it was you and 18 others. So if you have done any of this stuff, don't feel bad. Give us a call. We'll try to work with you, get it worked out. So don't feel horrible. Most dentists have been wrapped up into one of these, but it is fairly common. It's unfortunate, that conversation I've had to have over and over again through the years of, hey, you're not, but in-force illustrations are hypothetical performances. It would be the same as, now we're not allowed to do this and we would never do this, but we would show somebody, hey, if you invest in this, look how much money you're going to have, and showing them that, it's going to earn like 12% a year, which is absolutely insane. I can't imagine doing that. So we obviously don't do that. We're not allowed to, but somehow you're allowed to do this with insurances. Now, some funny things we've seen in some of these illustrations, like when you dive into it. One in particular, I know we were looking at, and, you're doing very simple math, and the math is the money in times the crediting rate used. You can sit there, oh, these are the deposits, here's the interest rate that the product is going to hypothetically earn, and you can calculate out what the value of the policy should be. Now, this is not that uncommon where the policy value exceeds the stated interest crediting rate. So we've got a huge problem there. That indicates there's negative mortality charges. Mortality and expenses, because the insurance company is going to charge fees on top of that cap. So, it's just mind-blowing to sit there and look at something where you're going to have to pay fees to the insurance company, but they're modeling out that they're going to actually pay you. And it's not every single one of them. Some we look at, and whether or not we agree with the fact they're going to get there, they're at least done correctly. But that stuff is just staggering. And then showing somebody that, the S&P, or you do this, and this is the cap rate, the participation rate, which kind of dives into a couple other issues on the list. They're in the illustration, but say, well, why or how did they come up with that, or what's wrong with the illustration? And one of the big things, other than it just being completely wrong, like 100% just wrong, something I like to call cap rate integrity. Now, when you sign this universal Indexed Universal Life, IUL?
Yep, you got it.
Okay, we don't sell these, so we don't know the jargon
rusty,
as well.
Right?
Little rusty. When you sell this, it's a contract with an insurance company, right? You don't have your own account of money. It's a contract with an insurance company, and they're providing you some guarantee in return. When you read the fine print of most of these insurance contracts, they have the right to change the cap and the participation rate at their free will, which sometimes can be the same thing. Sometimes you'll get 70% of the index. Sometimes you'll get the index return, less or something. But other times you just get, hey, you can get the S&P 500 capped at 9%. So if it does 30, you get 9. That contract usually states that the insurance company can lower the cap rate, lower the participation rate at their own doing. So it's a unilateral contract. It's no guarantee. So, it might start with a very high participation rate or cap rate. You might get in like 13%. We've got a 13% cap rate. The S&P 500 does 15. You get 13 of it. That sounds phenomenal. But then you go back 5 years later and the cap's only 9. It's 8. So the cap rate going down can be a huge problem. And they're illustrating one thing, but, in the background, they're going to change something else. So that can be a huge one. And same with the participation rates. There's no guarantee on those participation rates. So they're illustrating something that just ain't going to come true.
That's fair. And I especially saw the cap rates can be very dangerous because, okay, it seems like a win-win. You have a floor, maybe it's 0. You're never, quote unquote, never going to lose anything. Your cap is 8. But if you look at let's take the S&P 500, the history of that, most of the market growth usually comes in bunches, right? So, hey, the S&P was up 20% a couple years ago. Well, someone was stuck over here at 8. Yes, you didn't lose anything, but you're really, after fees, you're not getting 8% average annual return a year. Is that right?
No, that's right. And a lot of times too, people don't realize that most of these are done like point to point. So, if you're doing, okay, I've got 1 year, yours usually isn't January 1st to December 31st. It's usually your date to your next date. So it's kind of funny just based off of these caps that you could have two policies sold within a week of each other with wildly different returns if there was extreme market volatility within those couple weeks that there's not, or there's overlap one way or the other. So yeah, you don't necessarily get that, but that's the biggest thing there is if you're capped at 8 and the return is at 30, 20, and like these aren't that absurd of returns, you're not going to get that return annualized. I mean, it's not going to be your average or what you expect over time, but a lot of your return is going to come from big years, and you're stuck at 8.
Yeah, no, that's big opportunity costs there and uncomfortable. And we talked earlier, we both took the Series 7. We're both pretty heavy into the investments. We're talking a lot about rates of return and percentages, but I know that dividends are certainly a part of investments. And a lot of our investors and clients will count on dividends at the end of the year, or quarterly. Sometimes retirees will count on that for their income. Are dividends a part of this at all?
They can be, usually not. Usually you're going to do a price to price. So, you're looking at the percentage increase of the S&P 500, not what the dividends are paying out. And I think historically, the S&P 500 has done roughly 10% with dividends, a little bit over. And without dividends, Liam, do you know what the number is?
Oh, you're putting me on the spot. I don't know exactly, but it could be close to half that, right?
It is more than half.
Okay.
I'll give you
All
that.
right.
I'll give you that. Give me your best guess.
I'll say 7.
It's just a little over 7. You lose about 3%, not having the dividends. Now that fluctuates, sometimes up, sometimes down. A lot of dividends really have to do with the tax law and what the best way to return money to shareholders is. But yeah, I mean, you're already losing 3% there, so that's not great. You've got a cap on it. That's not great. And then, gosh, we're just going to pick apart these illustrations. So then we already know that we've got cap rate integrity. We've got participation rate integrity. We're not including dividends. We do have cap rates. So these are all bad things.
Right.
And then they're going to show us getting our money out tax-free. But Liam, how do you get money out of a permanent life insurance policy completely tax-free?
Oh, man, unfortunately, someone has to die for it, right?
Yeah, or how do they promote it?
Well, let me just tell you about this loan that you can take from borrow from yourself, man. Go ahead.
Oh, yeah, infinite banking, right? Yeah, so it's a loan, and when they illustrate the loans, they illustrate an interest rate on the loans. Loan rate integrity is a thing, too. You read that contract, that loan rate is not guaranteed. The insurance company is going to set it. So, yikes. So you're looking at it, then all of a sudden the loan rate goes up. And now this is always the funny thing because we see the illustrations on the front end that show them, oh my gosh, this is amazing. And then we see the real results on the back end of people that come in here 15, 20 years into a policy. And all of a sudden, all these rates and everything have changed. And yikes, I even had a client in a few weeks ago that we've got big issues because they thought these policies were going to be enforced forever. The problem is the fees and mortality expenses have gone up, and the policies are in jeopardy of not being enforced anymore because there's not going to be enough payment on it. What is the word when a policy is no longer in force?
Oh, man, that's a good
question.
question.
Policy lapses.
There you go.
Okay. The policy can lapse, and this can be dangerous if you, fortunately, this client didn't have a loan on it, so we don't really have any tax issues. But a lot of people get caught in this trap. They don't realize, okay, they put the money in, so let's just be realistic here. They put $1 million in over 20 years, and it's worth about $1 million. That's about normal.
I'd say that's generous.
It's probably generous. I've seen some that have made money. 80% of them are worth less than what the people put into them, I'd say. But now, okay, you got that $1 million, so you take a loan against the cash value to get your money out tax-free. Now, all of a sudden, the fee, the interest, and the mortality and insurance expenses start going up on you. And there's no cash value because you took it all out as a loan. So what ends up happening is you either have to pay additional premiums in, which can be hefty, or the policy lapses. Now, if the policy lapses, it had $1 million in cash value, you took it out as a loan and you already spent the money, and now the policy lapses. You're going to have a big tax bill.
My goodness.
It's going to be an ugly day, and people don't talk about the fact that these policies can lapse, but they absolutely can, and these illustrations should not be trusted.
Right. No, that's fair. And I always love when, all right, you meet this person and they're an insurance agent and a financial advisor and apparently a tax expert too, because, we can tax deferred growth and all of that. But when that comes out, when it lapses, when you surrender it, if there's a gain, that's not tax or capital gains rates, right? You're going to pay pretty much your top rate at that.
You are going to pay ordinary income taxes on that, which can be devastating. Yeah, I don't know how much worse it can get when that happens, and people don't really price that in, that it could happen, but it absolutely could happen. No doubt in my mind, especially if you're taking big loans against a policy. But yeah, you've turned a capital gain into ordinary income. People say, well, if I put $1 million in, I got $1 million out. I didn't have a gain. Wrong. The insurance company, you have a tax basis in a policy, and some of your premium goes towards the tax basis, but a lot of your premium goes towards expenses. So this is how you can have $1 million policy that you put $1 million into. They're telling you that it's returned 7% a year because they're calculating the return after the mortality charges, which that's basically the cost of insurance, plus the administrative charges in there. So if $400,000 of your money went into expenses, which wouldn't be absurd in some of these policies, then in this case, you would have a $600,000 tax basis. You'd owe ordinary income tax on $400,000 immediately.
My goodness. Scary day. That is, and that's the other concern I have is that when I talk to a lot of these clients who have these policies like this, they do it or they're bought into it because they're scared of the market and they're sold that this is a conservative way to invest. This is a way that you can save your money and not risk it in the market. It sounds like one of the riskiest ventures is putting your money in and maybe not having the same amount to come out after years and years and years. Probably much more aggressive than a traditional investment would be.
Yeah, you'd be better off in cash probably half the time. I mean, it's kind of sad that this stuff still goes on. People put a whole bunch, like I've seen a whole bunch of people argue on this guy on LinkedIn. He's hilarious. He argues with all the insurance salespeople in his free time. He needs to spend some more time getting some new clients, but maybe he gets some out of this. Maybe it's actually, I never thought of that. Maybe all the people looking at that read him tearing this guy apart and they call him like, hey, I clearly need to talk to you. It could be his whole marketing. His name's Andy Penko. I don't know him. I just find him hilarious.
I love it. Nice shout out here.
But yeah, he goes and argues with them all, and they're just selling it. And like, if you talk to these guys, they'll call us like, oh, let me explain the benefits of it to you. I'm like, dude, I'm a CPA that's well known for my tax knowledge. And they're just like, well, you don't know about this. I'm like, really?
I've heard it. Yep.
Like, really? You don't think I know about this? Like,
exactly.
No, I do know about it. It's an absolute scam here. Yeah. But if instead you put your money in the stock market of that 20 years, your $1 million probably goes to like 4. And sure, you can risk losing 30% of it, but you're going to risk losing like 30-40% of your millions, not your million.
Exactly.
There's no fear of losing money when you don't have any, but a lot of times too, they always talk and they argue. This is where I was going with that story. They argue about how the money gets invested and the strategies behind it. I think, I don't know this for certain, but I think if you oftentimes found that most of this money is just invested in the general account of the insurance company, and the insurance company just kind of sets what the spreads are, all that. They know what the policy is going to end up paying out, and they're taking the administrative expenses, the mortality charges on it. I mean, they know. So it's not, I don't know, there's not rocket science. I think people have this view in the background that like there's these really, really smart investment guys trading option strategies to make this happen. It's like, nah, it's probably in the general account of the insurance company because Believe me, you never worked on the institutional side, but are you aware of how basically insurance companies function?
I don't know. Share a little more.
They keep premiums with expected payouts, right? Whether or not it'd be a life insurance policy, whether or not it would be disability policy, whether or not it's going to be flood insurance, whatever it is that they're insuring, they've got really smart actuaries in the background. And the actuaries are calculating out based off the risk how much they expect to pay out. Now, they're collecting the premiums, but they're not paying out big events every single year. So they're investing the premiums, and they're typically going to be in really safe investments. They're probably the biggest buyer of corporate bonds is insurance companies. They're very, very bond heavy. Like we would look at it for a client if they came in with that portfolio and be like, are you scared of your own shadow? And it's not that they're scared of their own shadow. It's that this money is being invested to pay out claims. It's not being invested to beat the market. It's being invested to pay out claims. So it's going to be a lower investment return. And it's not a knock on insurance companies. It's just the business model. That's where your money's being invested. It's like this isn't it.
Right. Exactly.
This isn't it. Your money needs to be growing faster.
And if you take on that risk, you're paid for that. And to be able to say, hey, I'm going to put it into a traditional investment, that's right for me. And that doesn't mean you have to put all of the heat on, be very, very aggressive. No, you can have a conservative portfolio with traditional investments, just like those companies do. And I always laugh because when I look at the biggest skyscrapers around and I look at the stadiums like the New York Giants, the New York Jets, they play in MetLife Stadium, and the Texas Rangers playing Globe Life Park. These insurance companies are huge entities. They're not losing money on you. They are not doing you a favor. They are not your best friend.
No, they're definitely making money off of you, and they're investing conservatively. They just don't have a way to return this, money to you at a 10% annualized return. There's just no way for them to do it.
Sure.
So again, not necessarily knocking the insurance companies, and I'd say permanent life has zero place. Maybe though. We don't want to say zero, but we're in the decimal places there. I've seen some people use it for taxation purposes, or sometimes people can't get insured due to a health issue, and a permanent life insurance policy is kind of our only option. So I've certainly seen that too. We had a client straightforward tell us when I went and looked at it, he goes, I know you're going to be mad about it. I got it when I was 30. I had 2 kids and we had nothing else to fall back on, and my health didn't allow me to get insurance other than this. So he was like, I know it was a bad idea. I was like, oh, well, it served a great purpose for a long time for him. So not to completely bash him, but just like 99.7% bashed.
That's a pretty good guarantee. So that's fair. Did anything else on the list that you're thinking of? We don't want to beat it to death, but I think it's pretty much dead now. But anything else we haven't covered yet?
My last one is just the value of compound interest. And like we kind of went through and we talked about where you're losing money, different spots here. So kind of to recap, where are we losing money, right? We've got a cap rate or a participation rate. We're not going to fully participate. We're unlikely to be capturing dividends, right? So if we're S&P 500, we're about 3% lower right there. So we're just sitting there, we're just going down and down and down. Oh, then we're going to have administrative fees and expenses on the policy. Then we're going to have the mortality expense on the policy. And we just kind of want to overall look and remember the value of compound interest. Even at 3%, 3.5%, your money doubles every 20 years. It's 7%, it doubles every 10 years. And at 10%, it doubles every 7 years.
You got it.
All right, so let's just do some quick math with $1 million here. I'm going to be 40 years old and put $1 million into this policy. I'll be lucky if it doubles in 30 years. It's probably not going to move anything. Now, at 7%, I'm going to double every 10 years. So at 50, it's going to be 2. At 60, it's going to be 4. At 70, it's going to be 8. Compound interest is your friend. Now, if we're 40, though, and we're doing this, okay, we can probably afford to be more aggressive. We're going to get somewhere in the ballpark of 9 to 10, so it's every 7 years. So 47, we got 2. 54, we have 4. And then 61, we have 8. 68, we have 16. Like these percentage points matter.
Yeah. That is.
They matter a lot. And there's nowhere where it's just exaggerated more than getting into one of these policies versus just having it invested in simple things. And this is true. We'll probably have to start doing a bash that series. I like to be positive, so we'll end on our positive. Well diversified, low cost, to be in good shape.
Yeah,
It's
absolutely.
the name of the game. But, not that we want to beat something up, but we do want to prevent people from getting into these. A ton of people sell them. So I'll kind of end on, Liam, do you know the average commission that gets paid for selling a permanent life insurance policy?
Oh my goodness. You're going to tempt me to join the industry after I hear how much they make on some of these, right? But let me say 3%. That'd be nice.
No, typically it's gonna be more like 6 to 8% in an universal or indexed universal life. I mean, some are only 3, some can be higher, but yeah, typically it's gonna be 7-ish percent.
So the agents are pretty incentivized to. I wouldn't necessarily call them fiduciaries, right? They're given a reward to sell these.
Yeah, I mean, it's almost cheaper to just look at the guy and go, hey, look, if I go to the boat store right now and I buy you a boat, will you never call me again? Because that'll be cheaper.
Right. That makes a lot of sense. So, no.
But no, that's it. So just want to end, is an index universal life insurance policy an investment product, a permanent insurance or a life insurance product, or a scam?
Borderline a scam, right? It's a legal scam, but it is a scam nonetheless, I would say.
Yeah, the actual product itself isn't the scam, but the sales agents, what they promise, that's the scam on it. So do yourself a favor, buy term life, invest in low cost, well diversified, and get on your road to financial freedom.
Perfect advice. Thanks, Wes.
William, thanks for joining us. Everyone out there, we'll see you next time.